I would want us to look at just an overall picture of this AFM. Of course, some of those areas that are really, really common are these advanced financing decisions. You can lack a question from Odiglian and Miller. Those propositions, you can lack a question. And I would want us to start this at a low level, this financing decision. And I would want us to start with April 2023, question number 1A. April 2023, question number 1A, B. No, question number 1, A Roman 2. A Roman 2. April 2023, question number 1A, Roman 2. Question number 1A, Roman 2. Once you get the question, please put thumbs up for me. It has some theory, but I prefer doing these theories later. We will have 1 or 2 sessions of the theories. So we want us to look at Roman 2 right away. Once you are there, please put your thumbs up. They're quite very easy questions. So you're told there, selected financial information for Paybill Limited is shown below. They've given us yield to maturity on debt. They've given us what they are, 8%. Then we have a market value of debt. Then we have number of ordinary shares. We have market price per ordinary share, cost of capital of all equity financed. Then they've given us marginal tax rate. Additional information. John Njogu, a financial analyst, expects that an increase in Paybill Limited's financial leverage will increase its costs of debt and equity. Number 2, based on an examination of similar companies in Paybill Limited industry, Johnson Njogu estimates that the company's cost of debt and the cost of equity at various debt to total capital ratios are given as shown below. So they've given us debt to total capital ratio. Then they've given us cost of debt, cost of equity. Then they want us to determine the debt to total cost capital ratio that would minimize Paybill Limited's equity, Paybill Limited's weighted average cost of capital. You see, that's a very easy question. So first of all here, the examiner wanted students to know that when they give you debt to total capital, debt to total capital ratio, this is weight of debt. This is weight of debt. That is the first thing that the examiner wanted you to know. This is the same as debt over the total capital structure, which is debt over equity. So here, basically, they have given us weights of debt, weights of debt. So then we will be able to do a column here, weight of debt, weight of equity. I like putting them this way, weight of debt and weight of equity. So I can see the weight of debt there, like the first one is 0.20. The first one is 0.20. Then we have 0.30. Then we have 0.40. Then we have 0.50. Are you able to see the weights of debt? Somebody there, are you able to see the weights of debt being given? 20% is the same as 0.20. I want to move very slowly because now this is among our final classes. We need to start winding down so they can also give you time to study. It can also give you time to study. So then once we have this weight of debt, what do you think shall we do to be able to get weight of equity? Remember, these capital structure decisions, they assume that we have got 2 sources of finance. That is debt and equity. No preference shares. That's one of the assumptions here. All right, yes. So in this case here, to get this weight of equity, I will come and take 1 minus weight of debt because the 2 must be the same. So then 1 minus 0.2, this gives us 0.8. This gives us 0.7, 1 minus 0.3. 1 minus 0.4, this gives us 0.16. This gives us 0.5. 0.5. So up to here, are we together, ladies and gentlemen? Great. Then now move very fast with the precision. Go ahead and give us the famous WACC. Go ahead and give us the famous WACC. Go ahead and give us the famous WACC, weighted average cost of capital, which will be weight of equity cost of equity, plus weight of debt, cost of debt, and this cost of debt must be tax adjusted. The cost of debt must be tax adjusted. The cost of debt must be tax adjusted. The cost of debt must be tax adjusted. So the weight of equity, we can see it here. I'm using this. So we have here 0.8 weight of equity. I can see them 0.7. I can see them 0.6. I can see them 0.5. You say times. Do we have the costs of equity? Yes, they've given us cost of equity as the third column in the table provided. In the table provided, we can see the cost of equity. So the cost of equity in the table provided, I can see 12.5%. I can see 13%. I can write this as 0.13, no problem. So we have here 14%. We have here lastly 16%. Plus weight of debt, I can see weight of debt. Weight of debt is here, 0.2, 0.3. We have 0.4. We have 0.5 times the cost of debt. So are you able to see the cost of debt? The cost of debt has been provided. Second column of the table given. Second column of the table given. So then we have here 7.7, 7.7. We have 8.4. We have 9.3. We have 10.4. If I wish, I can put these percentages, or I write 0 point. Then remember that cost of debt must always be adjusted for taxation. Tax rate has been given as 30%, so 1 minus 0.3. 1 minus 0.3, so 1 minus 0.3, we are getting what here, 0. What here? 0.7, 0.7, 0.7, 0.7. I hope you're able to see where the tax rate is. The tax rate, marginal tax rate, is 0.3. So 1 minus 0.3 gives us 0.7. So I don't know whether up to here we are together, my great students. Great. Then you should be able to give me the final answers here. You should be able to give me the final answers now of WACC. So using your calculator just slowly, you will say 0.8 times 12.5 plus 0.2 times 7.7 times 0.7. You can ignore the percentages as you're working out. You can ignore the percent because they appear in both, you can ignore them. Or you say 0.8 times 0.125 plus 0.2 discretion, purely your discretion. Purely a discretion. So is there somebody who is able to give us the final answers? 2 decimal places if possible. Mother, she's giving me 11.08. So 11.08, 11.08, 11.08. And then we have the second figure here, obita, 11.08. Thank you so much. 10.86. 11%. 11%. 10.86 already have written right. Thank you very much. So the last one, or is that it? 11.64. West, best, optimal. Therefore, optimal capital structure. Yes. So this is the optimal. We normally call it OCS, optimal capital structure. Optimal capital structure, OCS, the second one, the one that corresponds to the best, lowest, etc. The optimal capital structure, OCS, debt is 30%, 30%, equity is 0.7, 70%. And you've finished the question. We were giving you that information on the very first paragraph there to simply confuse you. Apart from the marginal tax rate there is nothing we have used in this question, nothing. So we were just putting it there so you can get, in this case here, some people, these young people like Vero, in this case here, sorting it out so seriously in the exams. But you can see the question was what here was quite a nice one. Very sad, very sad. All right, and this question normally comes in two ways. First of all, are we in agreement up to here? Are we okay? Today we seem to be very quiet. I don't know why. Is there anybody who has a question? Anybody who has a question? We are okay. Thank you so much. Thank you so much. Especially here, debt to total capital ratio. Please get debt to total capital ratio. That is weight of debt. That's weight of debt. Then, ladies and gentlemen, the other one, in this case here, the other one, in this case here, is where now you are given, this is how the examiner cheats you. He'll give you debt to equity ratio, 0.5. He'll give you debt to equity ratio, 0.5. And then, of course, he'll give you several. He'll give you like another debt to equity ratio, maybe 1.2, like that. And then out of these, he would want you to come and create weight of debt and then give us weight of equity. Normally start with the weight of debt. Please listen. Whenever you see debt to equity ratio is 0.5, it means that debt over equity will be 0.5 over 1. There is an implied 1. Kuna a hidden 1. Kuna a hidden 1. And then once now you are able to decipher these, to get weight of debt, you will take debt over debt plus equity. So debt, I know it is 0.5. Over debt, I know debt is 0.5. Plus equity, now I know equity is 1. Can somebody give me this answer? So now we're given debt to equity ratio like this semester. You must know how to break debt to equity ratio into the various weights. We must know, because you'll be asked about optimal capital structure. You'll be asked about optimal capital structure. You'll be asked about optimal capital structure, and you will need this WACC thing. You'll need this WACC thing. So normally what I tell my students always, whenever you are given debt to equity ratio, this is something that you have to be very, very just passionate about this. We must know 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 this, ladies and gentlemen. Whenever you are given like debt to equity ratio is 0.5. And you want to get, in this case here, weight of debt. So normally what we do, we normally talk of 0.5 divided by, you open brackets, the same 0.5, even without reasoning. The same 0.5, you say what here plus 1, even without reasoning. Even without reasoning. Even without reasoning. So whenever you're given debt to equity to get weight of debt, you take this number that you are given plus divided by the same number plus 1. Don't even try to reason out. Don't try to reason out. Will this give us 0.33, ladies and gentlemen? Yeah. So if, for example, you are given like now this one, debt to equity 1.2, to get the weight of debt, you take the number you are given, you say tata into the same number, 1.2 plus 1. Don't ask even where 1 is coming from. Now we don't have, in this case here, time for many questions. Now we have all the time for cramming. But of course, you guys have shown you where that one is coming from. If you remember, I've shown you where the one is coming from. So then the weight of debt will be equal to 0. What here? 0.55. And then now you'll be able to get this weight of equities very fast. You've told me that the weight of equity will be 1 minus weight of debt. So this will be 0.67, isn't it? 0.33, 1 minus 0.3. So this will be 0.67. And then this will be 0.what here? 0.45, like that. And then, of course, these questions, all of them are the same. This examiner here was a very good examiner. Most examiners would expect you to come and use CAPM to get cost of equity. Most examiners would expect you to come and use CAPM to get cost of equity. And then, of course, some examiners will give you KD. Others may deny you this KD. But at the end of the day, you must figure out a way of getting WACC. So, ladies and gentlemen, can I run away now from this question? Can I go to something different? Have you guys gotten some good idea that you'll be able to use in your exam? Great. Thank you so much. Can they ask for equity to debt ratio? No, I've never seen that kind of a question. Catherine, they always ask for what here? Debt to equity. But just in case they ask you, and you happen to be having, in this case here, you see you have equity, you have debt. In case, but I've never seen them because it doesn't make sense in the capital structure. But in case, then you will come and take, in this case, if debt over equity, you see debt over equity, you can either use the debt amount equity, or you can even use this debt. Then come on top of WD over WE, the same. So if they ask you equity over debt, then you'll use weight of equity divided by weight of debt. But I've never seen this ratio applying anywhere. All right, thank you very much. Then, ladies and gentlemen, something very, very important that I would want you guys to really also be very good at, this semester as we wind down. Look at April 2022, question number 3B. April 2022, question number 3, boy. April 2022, question number 3, boy, was another question that was really, really poorly performed, very poorly performed by candidates. April 2022, question number 3, boy. And if you have done this with my colleague, please feel free to tell me no. Don't do that question, Mwalimu. We are comfortable because you have got so many questions to do during this sundown now, winding down of the semester. We have so many questions to do. Once you get it, please give me a signal. And if you've done it with teacher, always ensure that you tell me, Mwalimu, there is one, we have done it, we are okay. Look for another question, Mwalimu. We never woke up today to come and bore you. No, today is Nane. We need to be very happy. We need to be very happy. These Gen Zs have given us a holiday. They have it. So do I go ahead and do it, or do you guys have an answer to this? Do I go ahead and do it? Especially on the concept of share repurchase. Very few students were able to get this concept of share repurchase. Very few students were able to get this concept of share repurchase. So an unlevered firm is a firm without debt. It only has equity in its capital structure. An unlevered firm operates in a perfect market and has a net operating profit, EBIT, of 4 million. The required rate of return on assets of this firm in this industry is 16%. Assume that the firm issues 10 million worth of debt with a required rate of return of 14.5% and uses the proceeds to repurchase outstanding shares. There are no corporate or personal taxes. So they want us to give them the market value and the required rate of return of these firm shares before the repurchase transaction according to MM1. It doesn't matter which really proposition. This is a useless question, very easy question. Anytime they want us to give them value of a firm, always remember this concept of perpetuity. That is one of the assumptions of Modigliani and Miller, one of the assumptions of capital structure, that the organizations are going to stay with us forever. The organization is going to stay with us forever. So assuming in this case here that we were to have a great lady here, Frida. Assuming Frida in this case here was to get a very serious foreign boyfriend, very serious foreign boyfriend, because local boyfriends are not very, very serious. And then this foreign boyfriend of Frida tells her, every year, Frida, you'll be getting 10 million US dollars every year, forever. No growth rate, 10 million every year. It's a fund, endowment fund, 10 million every year. Up to when? Then Frida asks, up to when? She's told up to infinity, up to infinity. And then R in this case here is 10%. So then Frida is here coming to you as a consultant. She wants to know her net worth out of this transaction. What is her present value? What is her present value? What is her present value? Is there somebody who can be able to assist me? What is her present value? Thank you very much. It's 100 million. Because this is infinity. And whenever it's infinity to get market value, you simply take the cash flow, the amount, and you divide by R. So the amount is 10 million divided by R of 0.1. So this will end up giving me 100 million. This will end up giving me 100. The same case with these organizations. So these organizations are as well, we're going to make an assumption like this, that every year their profits will be the same, so that we can capitalize that profit to be able to get what here? To be able to get farm value, to be able to get farm value. So to get farm value here, so Modigliani Miller 1. Modigliani Miller 1. So Modigliani Miller 1, remember no taxes, no taxes. So to get farm value, no taxes, no debt, no interest. So to get farm value, basically here under Modigliani Miller 1, we are going to get value of equity, value of equity, because in this case here the farm is unlevered farms. The farm doesn't have what your debt. So basically the farm value will be what the equity holders have. It's only, the farm value is only defined by the value of equity holders, the value of equity holders. And therefore, to get farm value, value of equity, then I will take in this case here, EBIT is my annualized amount. I don't have to deduct interest because there is none, no interest. So this is the amount, this is the income, which I'll come and capitalize using R. I can't write R. I know in this case here, this will be K, cost of equity of unlevered farm. If you wish, you can say minus interest, even minus tax. But you see, tax and interest are what is zero. This farm is unlevered. There are no taxes in Modigliani Miller 1. No taxes in Modigliani Miller 1. So basically, it's a perpetuity income. So I have to divide this by required rate of return. And whose required rate of return? Cost of the equity holders. So has this examiner given me the EBIT? Oh, yes. He has given me the EBIT. He has told me it is 4 million. He has told me it is 4 million. So come and divide this by the cost of the equity and levered organization. Cost of the equity and levered organization. You can see there, the required rate of return on assets or farms in this industry is what percentage somebody. You can see the cost of equity, because the returns that we shall be able to give to the people who will give us the money here. That's what we're calling our cost. To the company, it's cost. To the investor, is required return. So to us, it's cost. So cost of equity is 0.16. So is there somebody who is able to give me this value? Anybody who is able to give me this value? So I'm being given that this value is 25 million. Very easy, really. Very easy. So remember, number one, they want us to give them the market value and the required rate of return of these farm shares before the repurchase transaction according to MM1 proposition here. So remember value here. To get, in this case here, total value, you simply come and tell him, you know how to do this. Total farm value, we are looking at the people who are propping up this company. The people who are supporting this company. We have got two supporters. We have equity holders and we have debt holders. We have equity holders and debt holders. So you know that total farm value, it should be equal to value of equity plus value of debt. So value of equity we have is 25 million. For sure we know the farm is unlevered. The farm is unlevered. The debt is zero. So then in this case here, the farm value will be 20 what here? Will be 25 million. Will be 25 million. So they wanted us to do two things there. To give the market value and the required return. They gave us the required return, by the way. At times the examiner made errors here and there. They gave us the required return. What he wanted us to give them there is WACC. And we know very well, all of us, I mean, we know this. We've been taught this very well by my colleague here. We know that WASHU should always be equal to KO. WACC of unlevered farm. WACC of unlevered farm should always be equal to cost of equity of unlevered farm. So no computation at all. This should be equal to what here? Should be equal to 16%. And that is the end of that question. That is the end of that question. Would have you gotten all the marks here? Is there somebody who would have gotten all the marks here? All of you, really. All of you, really here. But the most important thing, ladies and gentlemen, is to come and appreciate the formula. Whenever they ask about farm value, always remember Frida's foreign boyfriend. Always remember that. Very easy. Thank you. So then we can go now to number two. Number two. So number two, they want us to give them the market value and required rate of return of these firms' remaining shares after the repurchase transaction according to MM2. According to MM2. So, ladies and gentlemen, this concept of repurchase is quite controversial, but very, very interesting here. Very, very nice here. So the market value and the required rate of return for these firms remaining what here? Shares. So please give me the remaining value of equity. The remaining value of equity. The remaining value of equity. So remember, value of, it's the same firm which is now going for debt. Value of equity initially up there that we got was 25 million. And these guys are going to issue debt instruments worth 10 million. They're going to issue debt instruments worth 10 million, and then they're going to repurchase some shares from the market. They're going to issue debt worth 10 million, and then they'll use the proceeds here to repurchase some shares here. So in this case here, the value of equity that will be left. Basically, this is an equity debt swap. So you're buying the equity holders and increasing the debt. So in this case here, the remaining value of equity is 15 million. And we know the Modigliani-Miller 2 formula. We know Modigliani-Miller 2 formula. We know that total farm value will always be equal to value of equity plus value of debt. So, and of course, in this case, we talk of debt tax advantage. All right, debt tax advantage. So in this case here, plus DT, although we don't have tax here. We don't have tax here. All right, we don't have tax here. So in this case here, the total farm value will be value of equity plus value of what here, plus value of debt. After the repurchase, the value of equity left is 15 million. What is the value of debt? Can somebody give me the value of debt? Value of debt is how much? The examiner will use so much language and really there's nothing. The debt that we guys are borrowing is 10 million, isn't it? It's 10 million. So basically this remains as 25 million like that. This remains as 25 million. So basically here, because they want me to get WACC, they want me to give them what the weights. So in short, the weights, the weights. So we have here weight of equity. Weight of equity, it will be 15 over 25. I don't have to make it decimal. And the weight of debt will be this 10 over 25. I don't have to make it decimal, just leave it like that. Leave it like that. Leave it like that. So this was really, really important. The concept of repurchase. You take, in this case, the value of equity obtained above, and then you say minus 10. In most cases, when the examiner wants to confuse you, he will tell you that debt issued 10 million. And then they use like 8 million to repurchase the equity. They don't put the whole debt amount to repurchase the equity. So you must also be keen about that. So here they issue debt instruments worth 10 million, raise the 10 million, and then they use the entire 10 million to repurchase some equity, to reduce the equity, So then here we are. We've been able to get the weights here. And then I know, ladies and gentlemen, once in this case here we are in MM2, we must also get something else. In MM2, you must give us what we call CARE. You must give us, in MM2, you must come and give us cost of what here? Cost of equity. But now remember, this is a levered organization. You must give us scale. And the scale, there is a formula that all of us must be able to cram. There's a formula that all of us must be able to cram for getting scale under MM2. So to get scale under MM2, ladies and gentlemen, this is very, very easy. We talk of scale. So our KL will be equal to KU into, we have here KU, in this case here minus KD. Then we have debt over equity into 1 minus tax, although we don't have tax. The examiner has told us, hey, you don't have any tax here. No tax. If it was there, I would have said here 1 minus tax, but it's not there. Tax not there. So then our KL will be equal to KU. Do we know what KU is? 16%, isn't it? So KU is 16%. Plus the same KU, 16%. Are you able to see the cost of debt in this question? Yeah, we have issued debt instruments. We know how much this will cost us. We already have the interest rate. 14.5%, isn't it? 14.5%. So we have here 14.5%. 14.5%. So in this very question, we know what the debt is. We know that the debt is 10. And for this levered farm, for the levered farm, we can remember our equity. Is there somebody who is able to remember the value of equity for this levered farm? Is there somebody who is able to remember the value of equity for 15 years? 15. So remember they're in millions. If you wish, you can return them like that. So you don't have tax really. So 1 minus 0, which is the same as not writing at all. So here you have to go very, very slowly. Here, body mass, you must come and take 16% here. So this minus this gives me 1.5. You must go slowly here, very slowly. Times 10 over 15. Leave away that 1 minus 0 thing, it's useless. So body mass. First of all, you multiply before adding to 16. First of all, you multiply. Or you take in your calculator, you say 16 plus into bracket 1.5. Don't even put bracket. You can say 16 plus 1.5 times 10 over 15, and then you say equals, because your calculator has brackets automatically. So then what is the final answer here? So the final answer, ladies and gentlemen, that I'm being given here is 17. The final answer I'm being given here is 17. Are we able to get this 17, all of us? Are we able to get that 17, all of us? Yes. And then from there, I can very comfortably give my examiner the famous WACC. So WACC will be weight of equity, cost of equity, weight of debt, cost of debt. I don't even have tax. I don't have to say 1 minus tax because they have expressly told us there are no corporate or personal taxes. No corporate or personal taxes. So in my WACC here will be weight of equity. You guys gave me 15/25. Cost of equity, you've already given me the CAL, 17%. Plus weight of debt, which is 10/25, times cost of debt. We have already issued debt instruments, and we know what the rate of interest is. So the rate of interest in this case is 14.what here? Is 14.5%. So is there somebody who is able to give me this WACC? So all of us, of course, would have gotten this question right. There's nobody, I mean, there is nothing here to be missed out. No mark should be missed out. All of us, I'm 100% sure. I'm 100% sure that all of us would have gotten this very easily, really. I don't see anybody who would have not gotten this. So is there somebody who has learned something new here? Is there somebody who has learned something new here? Something that they will be easily able to use in their exams. Everybody who has learned something new here. Or these are, I mean, things that, we are very good at. We shall overcome. We shall overcome. So this is something very good, and ensure that you repeat. Not tomorrow, but today. Not tomorrow, but today. Not tomorrow, but today. 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 Great. Oh, it is 16. We're being told it's 16. Body mass. It's body mass. Body mass. Body mass. Body mass. Remember this, my handwriting will also be very bad. 14.5. So please, you take 15/25 times 17 plus 10/25 times 14.5. So this WACC will end up giving what percentage? I'm told will end up giving us 16%. 16%. So up to here, are we together? Are we okay? Can I move to something different? Yeah, thank you so much. Ladies and gentlemen, I want us to go to the new industry strategy. New industry strategy. New industry strategy. Hamada's model. Hamada's model. We are going to the new industry. Like right now, RCM is really doing very well in terms of high school tuitions here. I'm surprised. I mean, when we do just a simple advert like that, and then we get 100 students doing high school with us. So we are now getting into a new territory. So that RCM should be able to use Hamada's model. New industry strategy. New industry strategy. Great. Great. So remember, she's asking about what if, for example, they took, like, for example, the value of equity was 25. They issued debt, in this case here, debt, 10 million. 10 million. And then they went ahead, in this case here, to repurchase shares worth what here, 8. The same concept. The same concept. So this one here basically should have been what here 17 million. So you'd have used equity of 17 million, debt of what here somebody debt of 10 million. Debt of 10 million. So in this case here, your debt to equity or your weight of equity would have been 17 all over what here 27 like that. Same. All over 27 because of 17 plus 10 like that. All right. Ladies and gentlemen, we go to this question. This is a very, this is a very good question here. We are going to new industry. August 2022, question number 2A. August 2022. Question number 2A. I'm trying to look at questions that maybe my colleague has not tackled, but just in case my colleague had tackled this, please ensure that you just give me signal so that I can do a different. We have many questions to do today. Very many questions to do today. Very many questions to do today. So once you get it, put thumbs up. If you've done it, put thumbs down. I do a different question. I like challenges as well. So Mary Ann has gotten it and she's saying, Mwalimu, do it. Thumbs up means do it. We have Frida saying do it. Great. So let's do it then. Let's go to a new industry. Let's go to a new industry. New industry. So you're told LIB Limited. Don't read that. Read as LIBE. That's LIB Limited. By market value, debt to equity ratio by market value is 2:5. The corporate debt, which is assumed to yield a return similar to treasury bills, have a rate of 10% before tax. So basically, they are giving us risk-free rate. The risk-free rate is 10%. The beta value of the company's equity is currently 1.1. The average returns on stock market equity are 15%. The company is now proposing to invest in a project which would involve diversification into a new industry. Let's go to this new industry. Very easy thing. The following information is available relating to this industry. Average beta coefficient is 1.6. Average debt equity ratio is 1.2 by market value. The corporation tax is 30%. Determine the suitable cost of capital to apply to this project. I'll do this question in a very easy way. Very easy way. Very easy way. So solution. So in this case here, always go to the new industry, and they give us beta equity of the new industry. Just I repeat here. Go to the new industry. New industry. All information here will be about new industry. So go to the new industry. And they give us beta equity of the new industry. Yeah, it's August. It is August 2022, question 2A. The first thing you do, you go to the new industry and they give us the beta equity, what we call the bell of the new industry. And remember, we are using Hamada's model. We're using Hamada's model. And we know, ladies and gentlemen, in this case here, we have here beta equity of a levered farm will be equal to beta equity of unlevered farm into 1 plus D over E into 1 minus T, like that. Nimetupa makosa. nimetupa mbao hapa kidogo. Nimetupa mbao kidogo, nimetupa mbao kidogo, nimetupa mbao kidogo. Why? In this case here, you are supposed to go here and give us beta assets. Beta assets, sorry for that. Beta assets, what we call the BEW here. Sorry for that. Go to the new industry and give us its BEW here. Go to the new industry and gear. So in short, what we are saying here, the first step is that you ungear the new industry. You ungear the new industry. That is what you do first. You go to the new industry and ungear it. Remove any gears there. Watch a speed. Remove any gears there. Disrupt that market. So you go there and ungear the new industry. You give us assets beta, or you give us what we call beta equity of unlevered organization. So then I want everything new industry. So is there somebody, first of all, who is able to see the bell of the new industry? Please go to the new industry. You know, bell is beta equity of a levered firm. So go to beta for the new industry. Are you able to see there is a note there? Talking about paragraph 2. The following information is available to this new industry, of which you can see average beta coefficient of the equity capital. Capital. So you can see beta coefficient of this new industry, beta equity has been given. So the bell, of course, the industry must be levered. You can even see this new industry has got a debt to equity ratio. So it means that 1.6 is levered. 1.6 is levered. It's beta equity levered. So that is a given, which will be equal to BEW that now we are looking for. We are looking for this BEW into 1 plus for the new industry. Everything here is normally new industry. Everything now here is new industry. So is there somebody who is able to see debt over equity for the new industry? Still using this information, the following information is available relating to this industry. You can see debt, equity, debt over equity. You can see debt over equity is 1/2. 1 to 2. Debt over equity is 1 to 2. And then this debt to equity is the one that you do tax adjustment. So the 1 minus T, we apply 1 minus T here. So the 1 minus T, they have given us tax as 30%. So 1 minus 0.3, this gives us 0. What here? This gives us 0.7. So we start in this case here by going to the new industry, and then we do what here? We start by going to the new industry, and then we ungear it. I normally call that disruption. You disrupt. Like now how we have gotten to the new industry, this is high school, and we're getting numbers there. I'm so sure the numbers that we have for holiday tuition, not many high schools will be having such numbers. Not many. Getting, even if it's an Alliance high school teacher, getting like 100 students over holiday tuition, that is not very easy. And of course, our aim is to scale this up to maybe 1,000 from next, may not be 2025, maybe from 2026, every holiday, we'll be having 1,000 students, high school. All right. And even what we have now discovered, that most of these high schoolers, they are very, very bright. All right. All right. Most of the times in this case, it's about attitude. You know, most of them are teenagers. Maybe their teachers have pushed them a little bit like that, and then they hate them. They hate now the teacher, now they stop learning. So they come to us like, I'm the one who teaches mathematics. I'm able in this case here to tell them, no, you, after some time, I realized that these guys are doing very well. They're able to respond here. All right. So then can somebody give me this? So this is 1.6, which will be equal to BEW. Can somebody give me this answer? What do we have inside here? What do we have inside here? 1 plus 0.5 times 0.7. 1 plus 1/2 times 0.5. What do we have in brackets here? Erico is giving me 1.35. 1.35. So meaning that BEW will be 1.6 divided by 1.35, which will give us the what figure? 1.19. So if it's 1.18, we should round off a lot. I mean, yeah. So 1 point. So please don't put this early in form of percentage. No. 1.1 is not cost 1.185. So is that correct? Is this correct? Can somebody in this case here give us, so we go to this particular new industry and disrupt the industry by getting a bill, beta equity, unlevered of the entire industry. So up to here, are we together? Great. Thank you so much. Now, after that, now we go home. We go home. Now we localize this. So localize, we go home. We go home. So in this case here, after that, in this case here, we go to our company now and gear it up. For it to match with the industry, we must gear it up again using the Hamadan model. So Bell, remember, in this case here, home, what are we doing? We are going to use the beta of equity and lever that we got up there. It is the one that we bring home here and gear it up. We gear it up. We get our Bell. So now our Bell will be equal to, our bill is for the industry. This is for the one we got above, the 1.185 into 1 plus. Now here we use our parameters. Debt over equity for our firm, to our own company called LIBE Limited. So is there somebody who knows the debt to equity ratio of LIBE Limited? Debt to equity ratio of LIBE Limited. 2:5, isn't it? Thank you, Catherine. For LIBE, they have told us LIBE Limited debt to equity is 2:5. So we have here 2:5. 2:5. Into 1 minus tax is 0.7, like that. Because 1 minus 30%, meaning that Bell will be equal to 1.185 times. Please open brackets nicely. Give me the final answer. Give me the final answer. Give me the final answer. $1.52. And from there, we look at the cost of capital. Cost of capital. So cost of capital, according to this model, first of all, you must give us what we call a HELB. So cost of capital components. Cost of capital components start by giving us the HELB. Cost of equity over Unlevered. These guys were not as crazy as Modigliani and Miller. Not about Modigliani and Miller, these guys, they just wanted to kill our students. They went ahead and told us that HELB equals Q plus Q minus KD into debt over equity one. No. These guys weren't crazy. They told us to use CAPM. We need to use CAPM. They told us to use CAPM. And CAPM is very easy. It is risk-free. Plus PRM minus risk-free multiplied by beta equity. It has to be Bell of our company. It must be Bell of our company. It must be Bell of our company. So you're using CAPM. So are you able to see our risk-free rate? You guys, are you able to see our risk-free rate? It's given the treasury bills rate. Treasury bills rate. It is 10%. So we have here 10%. How about in this case here, returns from any market instrument given? Even as returns from a market instrument, are you able to see the average returns on the stock market? Yeah, thank you very much, Joy Frida. Great, Doreen, 15%. Stock market, 15%. Minus 10% into our Bell. Our Bell in this case here is 1.52. Then these will end up giving us what figure? You must ensure that you move slowly here. Take 10 plus into bracket 15 minus 10, you close, times 1.52. Give me an answer. So according to Frida, this is 17.6. According to Frida, this is 17.6. Is that correct? 17.6. Is that correct? 17.6%. Thank you very much. So cost components. I would also want to get KD. In most cases, it's normally given. In situations where it is not given, KD will always be assumed to be risk-free because most of these debt providers will ask you for collateral. So it means it is risk-free debt. You default, we sell your land. So KD, if it's not given expressly, it will always be equal to risk-free, which in this case, you guys have given me 10 what year, which in this case, you guys have given me 10%, which in this case, you guys have given me a figure of what year? 10%. 10%. Now, from there, we are done. From there, we know these cost components, we must combine them and give them what we call WACC. WACC. Fortunately, we know debt to equity. Debt to equity, you guys have given me 1/2, eh? No. You guys gave me 2/5, isn't it? So you 2/5. 2/5. So this is 2/5. This is 2. Remember, it's not 2.5. No. This is 2/5. So there are two ways of getting the weight of debt. Two ways, really. Two ways here. One of the ways is to come and tell me, what is 2/5? What is 2/5? Can someone divide 2 divided by 5? Give me an answer. 2/5 equals what here? What is 2 divided by 5? Is it 0.4? Great. So once I have this as 0.4, then I'll get weight of debt, which will be 0.4 plus, in this case here, not plus, but divide. 0.4 divided by 0.4 tata, divided by 0.4 plus 1, which will end up giving me what figure as weight of debt? 0.4 tata divided by the same number plus 1. The same number plus 1. So what will we end up getting? Oh yeah, they're not talking to me. Oh yeah, 0.29, like that. And then if that is the case, then I'll be able to get weight of equity, which will be 1 minus 0.29, which will be 0.71. 0.71. The other way that I've always seen students using, when you have debt over equity, please don't confuse this. Don't confuse this, please. Don't confuse this, please. Don't confuse this, please. Don't confuse this, please. So we have, ladies and gentlemen, our debt over equity as 2/5. So I know that debt is 2, then equity is 5. And the weight of debt then will be debt over debt plus equity. Very easy. Very easy. So I know that debt here is 2, equity, or rather debt first, 2 plus what here? Equity of 5. So this will be 2/7. 2/7. Which will end up giving us what figure, somebody here? .29. So this is method 2. And you must be comfortable in either. Not either, but both. If I were you, I would be comfortable in both. I should be able to derive my things here. Right? And then I can come and give my examiner WACC, which will be weight of equity, cost of equity, plus weight of debt, cost of debt after tax, because there is tax. So weight of equity, you guys have given me a figure of 0.71. Cost of equity, I've forgotten, but I remember it was 17 point something. Cost of equity, I remember it was 17 point something. 17.6%. Weight of debt, I can see it is 0.29 times cost of debt 10%, which is risk-free, times 1 minus t, which is 0.7, which will end up giving us what figure? $13.966. Don't tell me Mariana got it wrong. It happens, but I mean, now you can see I'm getting different answers from different students. I don't know who to believe. And I'm so sure it's because of this 0.7 that students, first of all, you get some students here, they get past this, and then they multiply this 0, which is wrong. This 0.7 is supposed to multiply. Don't put brackets anywhere. Don't say equals anywhere. You're supposed to go and say 0.71 times 17.6% plus 0.29 times 10% times 0.7 times 0.7. And then you give me an answer here. Give me an answer here, 14.53%. 14.53%. Great. Don't be sorry, we are learning, Marianne. 14.53%. Thank you so much. So, ladies and gentlemen, if this class was to end here, and then they ask you a question on this concept of going to the new industry, in your memory, from your mind, what are you able to remember? What are you able to remember? What are you able to remember? What basic steps will you never forget about this concept of going to the new industry? Without looking at your notes. Without looking at your notes. Without looking at your notes. Yeah, start with the new industry and then gear it. And gear the new industry. Yeah, and gear new industry always. And then our step number 2, we localize things. We also want, in this case here, our company to move very well with this industry. So we have to gear our own company. We must gear our own company. Remember, you take bail from above. Don't forget. Because what these guys will do, they are very clever. You see, like these guys, they gave you, if you look at these guys here, if you look at paragraph number 2, they gave you the beta value of the company's equity. They have given us beta value of our company, which doesn't have any relationship with the industry. So this beta value of our company's equity, currently 1.1, that is noise. I don't have to forget about it because they want to use that to confuse you, but they shall not be able to, they will not believe. The Gen Zs, they keep on telling us that even the government will not believe. They will not believe. So even for our case, CASNEB, when they try to confuse us like this, they will not believe. So before I disappear, I just have a feeling that we need to do one more question in this area. Or are we comfortable? Can Mwalimu go to something different? Or can I do one more, just one question, one extra question on this area? Or are we comfortable? Are we comfortable? Let's do one more, yes. Let's do just one more question. One more question. And I'll even do a question that you guys have done in class. The one of Dansoff Limited. Dansoff Limited. And I would want us to use April 2022, question number 1B. Don't look at whatever solution you have. Don't look at whatever solution you have. So we're using April, we're doing April 2022, question number 1B. Hamada's model, going to the new industry. Hamada's model, going to the new industry. And remember now here, I have another proposal. This proposal is that you guys put away your answers. Let's try to do this question using the method that I've just shown you. And I'll give you 10 minutes for that. I want to see how you guys will tackle this question. Only 10 minutes. Nobody's running away. Nobody's running away. We are at 86 now. Nobody's running away. We are doing this question 10 minutes. Let's see who will be able to bear the card. Someone is texting me that Mwalimu just finished the question because we need to go to work. Is that the case? Those 10 minutes, Mwalimu just finished the question because we need to go to work. I would have wanted you to try, but some requests are very valid. Some requests are very valid. So can I go ahead and tackle the question? Or are you at the middle of finishing? Almost finishing. Let me just do it because I think it was made some, you see, okay. So we do number one. Number one, if our debt to equity ratio is 20% to 80%. So we start the process here. So first, and gear the industry. So we are gearing the industry. Remember, we are told Dansoft Limited is a juice processing firm, which is solely equity financed. The company's board of directors are considering diversifying the operations by entering into the soda processing industry. The current unlevered equity beta is 1.4 for Dansoft Limited and 1.5 for this new industry. Now, remember, this examiner was very, very good. He basically, you want to get BEU of soda, of new industry, which is a bill of soda industry. So there is nothing really to be done because already has given us the ungeared, it's given us the ungeared or the unleveraged. It's given us this as 1.5. So here we shall not use any Hamada's model to do any ungearing. Is there anybody who tried using Hamada's model here? Please be very honest with me. Is there anybody who tried using Hamada's model here to ungear? To ungear what is ungeared already? Please be very honest with me. Thank you very much, Irene, at least on Frida. I like students who are very honest. They don't forget. Don't forget. You cannot ungear what has been ungeared. You cannot ungear what has been ungeared. Now, step number 2, now we get to our company, and gear it up. So I remember, gear it up here. Gear it up. I was confused. Great. So gear it up. So then our bill will be equal to bill into 1 plus debt over equity into 1 minus tax. So bill we are using 1.5 into 1 plus debt over equity. Are you able to see our debt over equity? Remember, it's number 1 here. Our debt over equity will be 20 over 80 times 0.7. Hope tax is 30%. Yes. Note number 8, tax is 30%. Note number 8, tax is 30%. 2 over 8, that's very good, Frida. That's very good. So are you able to give us our bill? So Moleri is giving us 1.6. How comes you're getting different answers, honestly speaking? Is it body mass? Is it body mass? Please ensure that you say 1.5 times open brackets. Good, these concepts are we're getting wrong answers today because we're going to get correct answers in our exam. So it will be 1.5 times open brackets. We have 1 plus 20 over 80 times 0.7, and then you close bracket to say equals. You say equals. So the final answer as per Bruno is 1.7625. Is that okay? And then we should always know when to round off. We round off when the figures are full in our screen of our calculator. But otherwise, if it's 1.7625, 4 digits here, 4 decimal places, why should we round off? We should write it in full. This is very good. 1.7625. So all of us, are we able to get this answer now? Able to watch a joke, because I calculator. Able to answer jokes here, watch a joke here, calculator. All of us, are we able to get this answer? All of us? Yeah, please ensure you're practicing now. Thank you very much. Now then, after this, ladies and gentlemen, we don't have anything much really. So after getting to our company and gearing it up, I know it's about cost components. So I know it's about CAL. So I'll go ahead and get CAL. So how do we get CAL? It's very, very easy. To get CAL, we're using CAPM. So we have risk-free, ERM minus risk-free, multiplied by the bell. We've gotten there. So are you guys able to see the risk-free in this question over here? Are you able to see the risk-free? Yeah, Catherine is giving me 12%. Have they given us market returns over any kind of market stock? Market returns or market premium? You can see note number 3. The return on the market portfolio is 15%. 15% minus risk-free of 12%. Multiplied by Bell, Bell in this case here, which is 1.7625, like that. So now they're giving us 17.28. Thank you so much. 17.28, 75%. Thank you very much. So in this question, can you kindly give me the weight of debt? In this question, kindly give me the weight of debt. So you have to be careful. It's always good to try. Of course, this was quite straightforward because it's given in form of percentage, but you must always try this. You know, always weight of debt is debt over debt plus equity. The debt is 20 over debt again, which is 20 plus equity, which is 80. So basically, this means that weight of debt will be 20%. It's given there, but it's always good. You go the longer way because in most cases, it will not be given to you in the form of percentage. So if weight of debt is 20%, then weight of equity is 80%. Weight of equity is 80%. Weight of equity is 80%. And therefore, ladies and gentlemen, to be able to get our WACC, it's weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus tax. So weight of equity, you guys have given me 0.8. So it's good you write weights as decimals. HELB, you've given me 17.2875%. Weight of debt is 0.2. Cost of debt is risk-free, unless they have told us. Is there somebody who is able to see the cost of debt in this question? Cost of debt in this question. Cost of debt in this question. It is the risk-free 12%. So it is the risk-free 12%, and this has to be adjusted for taxation. This has to be adjusted for taxation. So our WACC will end up giving us what figure? This is 15 point what here? This is 15.51%. 15.51%. So then after that, you guys will be able to do, again, this is something I've never understood why. You'll get so many students doing like 1 and 2 at the same time. No, they are optional. We should be able to do 1 to the end. And then we start now, Roman 2, using the same processes here, using the same procedure here, using the same procedure here, using the same procedure here. All right, so that is it, ladies and gentlemen. And how comes you guys have not yet signed for my Excel classes? We have Excel classes starting on the 26th. We had a very good offer. You know, when you talk of Excel, students don't understand why they need to do Excel, actually why they should have done this Excel long time ago. When you go to BDA, you need strong Excel skills. We have discovered the students who pass BDA first time, they are very good in Excel. All right, that's number 1. And then number 2, your workplace, given the dynamism, given now where we are heading towards, we must be very good in terms of what here, Excel, in terms of data analysis. Very, very good. All right. The Excel that I teach here is worth more than 100,000. That I can tell you because we train companies. It's worth more than 100,000. It's about coming up with dashboards. For example, I'll be able to show you today in the evening. So for example, when you have like data, like sales data, the whole of Kenya, I mean, your managers may want to know, for example, how near, if it's EABL, how consumption of a particular brand of EABL is in Nyeri, for example, county. So you need to prepare dashboards for various regions. You need how to pivot data. You need the lookup functions, like now the most current is called the XLOOKUP. I've done interviews. I remember there's a place where I went and did interview and I fell miserably simply because of what here Excel. Since that time, I endeavored to be very good at Excel. So we are charging you guys just 1,000 bob. You'll be surprised. That's a very, very good rate. That's a very, very good rate. I got comments from most of you telling me that Mwalimu, that this was quite sudden. You need to give us, like, for example, no, it can't go like, you know, you also want you to pay the normal rate. The normal rate for this Excel, we normally charge like 3,000 etc. So then the very best we can do is to extend that offer by just a single day. By just a single day. Will that be fair enough? You know, you always get students telling me that Mwalimu, I know advanced Excel. No. Like where I used to work at RO, we used to bring students from the big 4, not students but workers from PwC. We used to report them because outside here, I mean, The big four, they train their people a lot on this Excel, a lot. But down here, most of us, our Excel skills are not very, very good. They're not very, very good. So we need to really sign up for that class. Yeah, going forward with Excel, great. Yeah, it will come immediately after exams. It will come immediately after exams from the 26th up to 6th. And remember, those are easy. It is not like how we are teaching AFM. Excel is fun. You'll be surprised. It's fun. It's fun. It's about, for example, referencing, putting the dollar there like that. And we are doing it together. All right. So you like it. You like it. So very good. I can see somebody saying there, Mwalimu, we need to pay that thing. So I'll be able to extend this for just a day. And of course, you know, even the ITAX, so we get somebody like that. Now somebody was asking me, Mwalimu, how do you charge 1,000 shillings for ITAX? You're not talking of just filing returns. No, we have our CPA, Felix Mwalimu here, who works at KRA. You must be knowing that. Who will come and show you now the practical bit of this thing. How do we compute these tax obligations for company, for individual, for whatever? And then how do we file the same? So now you're doing this from the practical aspect so that now you guys can now start practicing. I would want to see students who are able to even say on TikTok that now you guys can come and we are going to help you on tax matters. You can file your returns. You can do this and this. All right. So then we have these courses which are very, very important. We have Advanced Excel. Advanced Excel. We have in this case here QuickBooks. We have in this case here Tally. We have Sage. And then of course we have iTax like that. So, and we're giving you a very good offer. Any three at 2,700. Any three at 2,700. If you're paying for any individual, is 1,000. Don't pay for all of them. Don't pay for all of them. You just pay for three. Pay for three because we have already done our mathematics. You are doing 4 of them at the same time. Those 2 weeks will be crazy. You pay for any 3 and everything will be very okay. So we have classes in the evening. Somebody was telling me that Mwalimu, after exams, I would want to relax. No, there's no relaxing because we want to make your work easier for BDA. That will be very good. So then today I will be meeting you guys at exactly 1 today. Fortunately, we've been given an off day. I'll be meeting you guys at 1, and I don't know whether I could get like a whole hour or 2 hours for advanced financial reporting. I also have something for you here. No. You pay for 3. You pay for 3 and learn the 3 that you will pay for. So if you pay for this and this and this, you learn those 3. So this and this and this, you learn those 3. You can't pay for 3 and you learn 5. You Joyce, you want to finish us. Or they want us to introduce SAP. Yeah, you can learn either concurrently, or in this case, you can have, you know, you're going to be very flexible. Early morning classes, lunch hour classes, etc. You can learn concurrently, or you can push, if you're very busy, you can push others here to another, even December, but you have to pay for them. For you to take up this advantage of this offer, you have to pay for them. So somebody's asking about how do you forget this? Our pay bill. You must have paid us a long time ago then. Our pay bill is 62,42,839. Account number, you simply write short courses like that. So what have we said about this AFR? Will you be able to get time for AFR? There's something I have for you. Yeah. Something else. I think today I'm talking too fast. Something else. On this AFM Steele, there's a video that I did for you on binomial. It's called binomial. So you have to watch that video of binomial, and then I did something for you on multilateral netting. Is there somebody who has seen that multilateral netting? You know, I want now to wind down. Now we are winding down. Because now it has reached a point, I also need to point out to you videos here and there. You keep on watching them. We can't be doing classes throughout. We need to start winding down. So have you watched that video on multilateral netting? Is there somebody who has ever watched this video? multilateral netting. Oh, Eric has never watched it. I mean, you've never seen this totally. Allah. Okay, is there somebody who has ever watched it? Is there somebody who has ever watched this video? Ah. Yeah, it's on the LMS. Then I'll be able to go to the LMS and I mark them. That's what I'm doing today in the morning because I'm free. I should be able to mark those videos for you. Those videos for you. Please watch them. Watch them. Watch them. Watch them. Watch them. How about special revision? I'm not aware of any special revision class that was to be charged here. If you paid for any special revision class, you need to transfer that money to, where? You need to transfer that money to these QuickBooks and whatever. I'm so sorry, I'm not aware of any special revision class. We said this time around, you're not charging any special revision. That's what we said. That's what we said. We're not charging any special revision class. Why should I charge you the special revision? And I'm giving you videos. I'm giving you one to watch this one to watch. Or which kind of special revision again would you want, you guys? But unless I'm wrong, please correct me. The only thing we could do is, for example, some students will tell me, Mwalimu, this topic, please come and take us through this topic, those areas that you think Mwalimu may come from this topic, like this Modigan and Miller. Some guys will tell me, Mwalimu, come and just check this. Like this concept of money markets again, Mwalimu, come and check this and this. And then what I'll do in that case, the areas you ask, I'll first of all provide a video. And then should there be need, then we do. Of course, our classes are continuing to the very end. Our classes are continuing to the very end, but now as we draw down everything, I need to keep on telling you, watch this, do this, and this. I'm not going to cut away classes. I will be with you, but I need to keep on guiding you. Like now, I want you guys to watch multilateral netting video. All right? You have to watch, in this case here, the binomial tree. Very, very important, very easy. Binomial tree. I'll be able to highlight this. Very, very important. And what you have done today is also very, very important. You must repeat those questions. You must repeat those questions. All right. Or there is a group also on special revision. I don't know why that came. Or last mile, okay. Allah. You guys, we paid. Then I'll have to see what to do. I mean, these are so many people. I share the timetable, yes. These are many people. No, we don't want to appear like we're calling. No, we have to find a solution to this. Either we transfer you here or we come up with that. So that I would want to see that special revision group. Somebody tag me there. 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 Thank you so much. Have a good day. And bye. Yeah, Mariana, I'll be able to highlight. I'll be able to highlight them. I'm just getting to the LMS, then I highlight them. I'll be able to write down into brackets binomial, multilateral. I'll be able to write there. I'll be able to see. I'll put them under the remedial classes. I'll put them under the remedial classes. Under the remedial classes. Good day. So see you guys at exactly 1 p.m. for AFR. I have something for you. Thank you. Oh, it has not been created. Frida is saying I tagged you. Mary anasema na ukuje kama umechangamka. Kwani sichangamka asubuhi? Mwalimu hajachangamka. What do you mean? I thought, I mean, you know, there are serious things Mary Ann have to also wear at times, in this case here, some serious face. Uko down, bad. No.